This is 2023 performance for something that you've heard, probably if you read the financial pages, called the Magnificent Seven. So brokers who want to get you to do things have wonderful ways of inventing names for things. The bricks, the Magnificent Seven, the fangs, etc., etc., etc. The Magnificent Seven are these stocks, 7 stocks listed here. You'll see that the NASDAQ, the US index, delivered 43% return last year. A lot. That's a lot. Right? These 7 stocks delivered 2/3 of that return. If you didn't own all or most of these stocks, it was close to impossible to outperform, basically. Looking at them, we don't own any NVIDIA, and I know that Ian, who does alert us if he's got a question that we need slides for, has got a question for us later on about the hype, if that's what it is, or the story around AI, which has driven this company, which designs chips for the GPUs, which are driving the models for AI. We don't own any of that. We do own some Meta platforms. We're never going to own Tesla. We did own Amazon, and I sold it. We'll probably deal with that a bit later in terms of how good or bad an idea that one was. We own Alphabet. We do own Microsoft. We do own some Apple, but we own a very small amount of Apple.
Here's Fundsmith's latest 13F filing. As you can see, they have 12.5% Microsoft, 7.4% Meta, 4.1% Google, and finally, just 1.08% Apple positions.
And the reason for that is we started buying it a year and a half ago when it was rated about the same as the S&P index. We thought, if it's the same as the S&P index in rating, we're probably all right because it's a lot better than the S&P average. Started buying it, and we foresaw correctly that it was going to have a series of quarters of poor sales coming up. It's had 5 or 6 in a row since we started buying. The only thing we didn't foresee is that the share price would go up 50% while that was happening. So we haven't got enough Apple, or we didn't have enough Apple. So, you know, that was the 2023 background to performance, just to let you know, okay? And just to give you a reflection on it, the Magnificent Seven, I like movies a lot. I'm very keen on movies. And I think you can learn a lot from movies. One of the things that I think you learn if you watch enough of them is there's no such thing as a new movie plot. Everything's been done before. Basically, it all gets rerun. And the Magnificent Seven, which they've used as this term for these 7 stocks, which drove the market performance last year, of course, comes from the 1960 movie of the same name. Have we seen this movie before? You bet we have, because in 1954, the 7 Samurai was released. And the Magnificent Seven is clearly a copy of it. They just wear cowboy hats and carry guns instead of swords. So we have seen this movie before. And you know, the Magnificent Seven stocks, we've seen this movie before. In 7th of April 2000, Goldman Sachs named their Super 7. I'm guessing that they maybe had somebody who liked Lotus or Caterham cars on the staff at the time for Super 7. And here they are: First Data, Oracle, Teradyne, PMC, EMC Squared, Cisco, and Dell. Those were the Magnificent Seven of 2000. How did they do?
Here's the Super 7 from more than 2 decades ago, and most of the names here are completely irrelevant today. That is the hard side of capitalism, showcasing the dynamism and volatility of the market. This reflection underscores a fundamental truth of investing. Today's titans can become tomorrow's footnotes. The evolution from the Super 7 of 2000 to the Magnificent 7 of today is not just a tale of companies rising and falling. It is a vivid illustration of capitalism's relentless cycle of innovation and disruption. As investors, it reminds us to stay adaptable, informed, and always ready to reassess our positions in light of the ever-changing market landscape.
There you go. There's the next 5 years' performance there, and there's the next 10 years' performance there, basically. Julian and his team, who have to prepare these things I dream up from time to time, struggled to find some of these because they barely exist anymore, you know, in terms of where they got to after this. And there's a great saying: history doesn't repeat itself, but it rhymes. Right? And I think we may find that if we had, on your behalf, entered into a full-blown Let's Own the Magnificent Seven last year, we might eventually be into watching the sequel to it, and with the same outcome, basically. Just to give you one other illustration, this is about how this is a portfolio, and we have to be. It's nice to own things that go up a lot. It's great. But you have to be a little bit careful about what you get on the way to them going up a lot and how it affects our decisions and your decisions. Here's a stock, a real stock. You could have bought it in February 2018 at $127 a share. By September of 2021, it was at $273, so it had more than doubled. And recently, it's been trading at $484, so it made a 196% return during the 5 and a bit years in there. Pretty good, isn't it? Want to own it? I want to own it. I'm in, if you are. The problem is it did this, right? Yeah, it went from there to there, which is what you've just seen, but it had these three really big downturns. One of them was 76%, right? How would you feel if you owned this stock? Even though we now know, with the benefit of 2020 hindsight, that it was a great returner, how would you feel round about there? Yeah? Now, I can tell you how I felt, because it's Meta Platforms, right?
If you too have recognized this company as soon as you saw the numbers or the charts, I want to congratulate you on holding, or even buying and holding, Meta like me. Those were the times. I actually wrote a comment on a Joseph Carlson video, where he covered what was going wrong with Meta. He is a great YouTuber, and I will leave a link to that video in the comments as well. In the comment, I said Apple's changes took $10 billion of Meta's top line annually according to Meta. Their expenditure is not all metaverse. Actually, more of it is AI capabilities to better compete with TikTok. People hated Zuck when he bought Instagram and WhatsApp. They have close to 3 billion daily users worldwide, and it is literally the most hated stock. I don't think Mark will be spending all that much on Metaverse, without any results for years to come as well. Meta is my top holding, and I'm down a lot. But as Buffett said, if you can stomach a 50% decline, you shouldn't invest in individual companies. I see nothing wrong with the fundamentals of the business, and the expenditure is expected to top in 2023 and cool off thereafter according to analysts. I think investors who go long Meta will be handsomely rewarded in 5 years. This video is a good bear case though, and I might be wrong as well. We will see. Well, it turned out the investors didn't even need to wait for 5 years.
That's what we've lived with through this. And to give you a picture of this is what we manage is a portfolio. It has some things in there which are quite staid, which don't ever produce returns like this. You know, the Unilevers and the Procter & Gambles and the PepsiCos of this world. We don't own all of these. Even if we thought we could identify a Magnificent Seven, we would not take the risk of owning them. Right? Because they can do things like that. And when they do things like that, it causes you to get worried, and us to get worried, and both of us quite possibly to make bad decisions based upon those emotions. The Meta Platform story, I was in New York, sort of round about here at one point, meeting with a big wealth management private office that we manage money for in the United States. And the young associate, or younger than me anyway, associate was giving me a reasonable hard time about Meta and what we thought about it, and I was giving him our answers and so on. And his much older and obviously wiser boss said, every portfolio should have one stock like that. If you believe what you're saying, you should buy more. And we did. And it worked. And isn't it great? The most important thing that that man said to me was one stock. Right? You don't want 27 of them. Because if they all move in unison like that, I'm afraid it's game over. Right? We're not all going to have the fortitude to live through that, even if we should have in the end.
I believe Terry Smith made great points here. And let me just say that I also see incredibly good future prospects for these companies in the future. They have a lot of room to grow as businesses. The problem is some of their valuations, especially Tesla and Nvidia in my opinion. While I don't think these 7 will be irrelevant 20 years from now, just like Goldman's Super 7 from 20 years ago, that doesn't mean they will deliver great returns as stocks, at least some of them. If I had to guess, I would say Amazon will have the highest returns in 20 years and either Tesla or Nvidia the lowest. But that's just my personal opinion, and I barely follow these companies. So there is a great chance that I will be wrong on this one. And since I am neither long or short on them, that is irrelevant for me. It is in my too hard pile. And the reason I don't follow these companies is simple. Almost every eye in the financial world is covering them. And while anomalies like Meta a couple of years ago can happen, it is unlikely for the most part. So what I try to do is look at places with much less eyes on, companies like Reysaş or TAV Airports. If you want to learn more about the businesses that I cover, please check my other videos. Also, subscribe and ring the bell if you like the content, so you won't miss my future videos. That was it for today, and I'll see you in the next one.